Hey guys, Sean from Invest to Live. So today going to be a pretty quick video, but based on some comments I have been reading today on other videos, I thought, you know what, I'm going to actually pump the brakes and talk about something I think is really important, especially with the way the market has been going up, as well as still seeing some recovery in other stocks. So what I want to talk about is high yield dividends, because I've been seeing this a ton lately where people are claiming they have found stocks that are paying 10, 12, 14% dividend yields, and they're putting all their money into it because it's going to help them achieve FIRE and retire early and all these great things and this income that's never going to stop. And this is sort of part of a larger trend of the Robinhood and Webull trader, which is, you know, they're relatively new, may not have a ton of background in the way the market fundamentals work at sort of that economic scale or the mechanics behind the way trading goes down, and sort of what kind of factors or reasons you might see a high yield like that. So as always, I'm not your financial advisor and I'm not giving investment advice. This is purely for educational purposes only. Please always seek out professional advice on any of these topics. So rather than belabor the point, as I say practically on every video, and also point out my hair and beard definitely need a trim, but for now we'll go with it. So here's the thing. Dividend yield is directly related to the dividend payout against the stock, the current price of the stock or asset that you're putting your money into. The yields can be all over the place depending on the type of business. Some stocks don't pay a dividend, some do. A lot of times you'll see growth companies not putting a dividend out. Other cases you'll see more established, mature companies with a nice dividend. Typically we see dividends in the range of anywhere from 1 to 5%, say. Sometimes you'll find some good REITs that pay a little bit higher, or some oil lines that might pay higher than that. And there's of course other great payers out there. AT&T is a great one with a high dividend for a long time now. What I'm really talking about today is when you find these really low price stocks, or these stocks that have crashed downward in price, and suddenly they've got a 12% yield, and you think, wow, 12% of my money, I'm going to retire in no time. I'm going to double down on that. I'm going to put my money into it. Here's the thing. That yield is based 100% on the fact that that stock price has gone down, and that's where the yield is coming from. It's an artificial yield. This is important because with everything going on still with the pandemic and coronavirus, we're 100% need to be aware that although the market's been going sort of back to a good place and we're seeing asset prices rise, especially within the stock market, oftentimes what these companies will do is they'll lower that dividend down to be back into a range that's affordable for them, because those stocks have typically dropped so drastically because of a lack of revenue, or guidance is wrong, or they missed their earnings, or just new expenses, or a lack of customers, or whatever that reason might be, to cause the stock to come down and lower their market cap. The way dividends work is you may not necessarily see an immediate drop in yield or a cutting of that dividend price. So it's very much a lagging indicator to the stock price. A lot of times they'll decide ahead of time for the next quarter or next few months what that payment will be. So you may not be aware that at a board of director level, there's already been a decision made to cut that price in half, for example. During 2008, when the market crashed, we saw many of the financial stocks completely cut their dividends away to zero, which only further dropped the prices even more so. So if you're living off those dividends of financial stocks, you suddenly were now at zero, which is really scary. And this is what I want you to think about as you're looking at this. And I hope a lot of people understand where I'm coming from. Dividend investing is awesome. I do it. I love it. It's a great way to build towards your future, build towards retirement, build towards an early retirement. But you have to understand that there are economic fundamentals that apply to the way companies put dividends out. It's based on cash flow, the ability to give profits back to shareholders. If they don't see profits coming in the same strength, that's going to affect the ability to keep paying that dividend. So when you're looking at these high yield dividend payers, do the research and do the homework to understand, has there been a big drop in price? Have there been missed earnings? Have there been any kind of negative news about this company that might be a reason for that dividend to suddenly drop down and be cut or be eliminated completely? This is nothing more than just a word of caution, and something that anyone who's new to this world of trading and investing and looking at FIRE and everything else that's out there, these are the kind of things you really need to be aware of and make sure that you're covering your basis, because what you don't want to do is load up on one of these stocks because of a high yield just to see the yield get cut and then the stock go down even further. So keeping it really short today, I'm going to sum it up like this. If you see a high yield that you think seems completely unbelievable for the market we're in today, especially for a certain segment that you're investing in, do the research, make sure it makes sense, and understand if they can actually pay it. One other thing I'll call out as well, don't always confuse yield with being pure profits. A lot of close-end funds, which we can get into another video, but CEFs, as they're often called, will actually return investor capital as part of that payment. So what you think is dividends coming back to you in the form of profits might also be capital coming back, which over time is unsustainable for most businesses. And that's when we see those big dividend yield cuts as well. So that's it for today. Keeping it short based on some comments I've been reading. Keep learning, keep striving, keep investing. We'll talk soon. Thanks.